Morning. Hello, everybody. My name is Mohannad Al-Suwaidan. I am a PhD student here at the Fletcher School, and I'm very happy to be moderating this amazing panel we have for you today on the finance and the weaponized interdependence in the world of finance. We all know the U.S. has a very central role in the global economy, and the U.S. dollar specifically has had a lot of leverage over the global economy. Weaponization of this position has been feared since the Bretton Woods Conference, where the French worried about handing over to the Americans the exorbitant privilege. However, are we seeing a breaking point that will cause a shift away from the US dollar, or are the network externalities simply too powerful for this change to happen? How much can the non-state alternatives, such as cryptocurrencies, blunt the effect of weaponized interdependence? And will the US remain the lingua franca of the global economy? These are big questions we have. And to answer these questions, we have an amazing panel for you guys today. Starting with my left, we have Professor Thomas Oatley, Corasaniti-Zondorak, Chair of International Politics at Tulane University. Rachel Ziemba from Ziemba Insights, the founder of Ziemba Insights. Mark Blyth, the William R. Rhodes Professor of International Economics at the Watson Institute for International and Public Affairs at Brown University. And finally, on Skype, we have Elizabeth Rosenberg, Senior Fellow Director for Energy, Economics, and Security at the Center for New American Studies. Elizabeth, can you hear us?
Yes, can you hear me?
Very well.
Yeah. Very well.
So with that, I would want to open the floor. We want to start with Thomas.
Okay.
Or we want to start with
I think
Rachel?
go with order of the program.
Yeah.
Okay. Great. I didn't realize I was first on the program. Okay, so wonderful.
What is the order of the program?
Okay. Anyway, I'm happy to start. So what I want to do in talking about finance today is to sort of pick up on some of the points that we talked about yesterday and in the paper around the network effect. And there are many there's a deep example around finance in the paper, and some of the fellow panelists, I'm sure, are going to go into cases of the effectiveness. I want to try to do two things. One, to look at some of the ways in which these tools have been self-reinforcing, the ways in which networks and some of the power might have been extended by their use, but then raise the question whether we might get to points and risk of fragmentation and creation of subnetworks. I'm not here to say that we are quickly moving towards a meaningful, high-level challenge to, for example, the US dollar-based financing system, but I am raising this question mark about whether we're moving to fragmentation. And in doing so, I'm going to look at summarize the literature around some of the liabilities, some of the spillover effects that might have led to counterproductive nature. Yesterday's conversation I thought was really good in bringing us back to this question mark of, it's not just about are these tools being used and having, say, an economic effect, but bring us back to power projection and discussions that I'm often taking part in, which is, are these effective in leading to policy change? Much of that is with the good work that Liz and her team that I'm privileged to be a part of at CNAS do. So I'm sure she'll pick up on that. So firstly, what's the evidence that in some cases use of financial has deepened them? One example I would highlight has been, one example, somewhat in the paper, somewhat in other notes, has been the way in which US and European coordination on Iran, particularly around use of the SWIFT networks, then led to greater connection of those networks, which arguably made it harder to disentangle. We can come back to this. The other area I would say is that the private sector themselves, especially the banks, which tend to be the most cautious, if anything, have had, as new examples of financial sanctions have been implemented, have had what policymakers would call muscle memory. That there has been fear of fines in the past, fear of fines in the future, uncertainty about what those costs are, have led them to say, well, let's just be cautious. Let's maybe not wait, let's disengage from a country, from a place like Iran first, and then ask questions second. And that has contributed to another concern and trend, which is one of de-risking. De-risking, which in a sense is used often in the literature for looking at a circumstance where there is a broader increase in the risk premium that may go beyond actions and channels that are disallowed to a wider sense of risk premium around the entity. One could look at it and say in a period of coercive policy and power being on the rise, that would actually be a function and a part of the design rather than a flaw. But I think we can look at plenty of examples, including the unwinding or suspension of sanctions after the JCPOA, to look at examples of where de-risking complicated the removal of sanctions. I recognize in this environment today, maybe it sometimes seems naive to think about the removing of certain sets of sanctions. But if we're looking at effectiveness and policy change, the broader trend of having this lasting risk premium and the broader trend of having, in some cases, a wide variety of reasons why individual companies or banks or countries are sanctioned, I think creates problematic, because how do you certify that Russia, that Iran has met the, say, 5 requirements? So we can go in, I'm simplifying a number of different tools and mechanisms, which we can get into later. And then I would just add one further consideration, which is that, and this draws on some of the work of, Adam Tooze and others, but the way in which the use of swap lines and the like also sort of deepen the role of the US dollar financing system. So let me get to, so that's maybe some arguments of how you had mutually reinforcing trends. Why is there this challenge? The biggest one and reason for pushback, as we've been talking about, has been one of particularly the use of unilateral extraterritorial sanctions by the United States. And there are 2 sets of countries, some of which we've talked about, that have concerns about that, maybe more. But one is a set of countries that either at a country level or major sectoral level or even an individual level have been the targets of sanctions. Russian entities, Venezuela, Iran, Turkey, a long list, might have interests in pushing back against these measures. These are measures that may involve the restriction of access to finance, not only from the US and US persons, but European banks, Japanese banks, et cetera. The other set of concerns actually comes from US allies rather than some of the adversaries. The Europeans have been most vocal about this. At times the Canadians bring up these issues, and I would say there are concerns from some of the developed Asian countries, but they're less vocal about it. And that is a concern about whether they have the scope for independent foreign policy, or whether they are just able to, say, pile on when there is sort of US policy, but can't balance against it. The Iran case underway right now is, of course, a test case for this. The EU has announced a few tools that try to balance against some of the new round of sanctions from last year. These include the blocking mechanism and the much talked about but little implemented special purpose vehicle. The blocking mechanism, which some of you may recognize from Helms-Burton and other sort of Cuba historical periods, its goal is to provide a framework for European companies to shield themselves. At this point, there have not been many European companies that have been willing to be test cases for this, but we can go into that in the Q&A. So I want to look at, so here's some of the reasons why there might be pushback. In the last very brief bit of time that is allotted to me, I want to look at the role of the US dollar and whether we might see where we might look for evidence that it was really being challenged either at a global or regional level. And I'm going to draw extensively on some of the policies that Russia has done to start from, and I'll welcome comments around that. From one way of looking at this, the challenge to the US dollar rhetorically is not necessarily new. There's a lot of literature around this. Would the euro, would the renminbi supplant it? And so far, you know, the euro really sort of capped out at 20-some% of trade, of reserves, and the like, and sort of got stuck at those levels. There has been a resurgence in rhetoric out of Europe, partly because of some of the things I mentioned, about whether the Europeans might think about buying more of their oil in euros. That I think is probably more rhetoric. Now, where we partly because for a variety of reasons we can go into. I'm partly new commission posturing, but like Henry mentioned yesterday, I think it'll be interesting to see what new tools, if any, the commission brings to bear. So where do we have and there are constraints, including availability of assets, particularly for savings within the Eurozone. Those involved in saving, and which is reinforced by the fact that, of course, the ECB is the incremental buyer of almost everything that is issued. But but let's look at the case in Russia in particular. Over the last 2 years, as an escalation of a move to de-dollarize that started some 15 or so years ago. And we've seen a reduction we now have the Russian central bank has about 24% of its reserves held in US dollars, down from about 40% less than 2 years ago. A sizable escalation in that decline after the Rusal sanctions were imposed. We've seen not only a move to additional euro holdings, which had been the structural shift, but also Russia now accounts for about 2/3 of global renminbi reserve holdings. Now, this is just reserves, and this is only a small part of both global reserves and even Russian assets. The thing we have to, in thinking about these challenges, I think it's important. I'll come to an end shortly. In thinking about the challenges, one of the big questions is not only around savings, but also the other uses of currency, its use as unit of account and means of exchange. And that's where I think there are a couple of things important to watch, particularly in the energy markets, which we might get to later in the day, where we have Gazprom and other entities start trying to step up a process of asking for payment in other currencies. Now, at the moment, first of all, it's not clear whether the buyers are taking them up on it. Secondly, it's structured these contracts are structured in a way that the payment might be in euros or it might be in a third currency, but the price is still denominated in US dollars. But I think this, given the sort of flow of funds and the like, I think this is somewhere important to watch. And the other thing that I think becomes critical is not just a story about Russia, but also a question mark around Chinese savings policies, other saving policies. And finally, and I think the bigger sort of question mark will also come in whether we have these formal structures or whether we see a greater use of payment systems that are structured between the countries, perhaps leveraging the existing system. And that, I think, creates a potential risk because you might have pockets of the global economy that are harder to survey, maybe harder to have that panopticon effect that we've been talking about, and harder to assess for a wide variety. So I think structurally, maybe not a big challenge, but I do think we might be there is the possibility that because of the costs and externalities that there might be some new sources of new subnetworks developing, and they might not be they may be costly, but that might be something that countries decide is worthwhile to survive, even if they're not thriving. Thanks, and apologies for running over my time.
Rachel, we move on to Thomas.
All right, thank you. So thank you, Dan, for organizing, Abe and Henry for inviting me and everyone else. It's been fascinating thus far. So I'm going to make 7 points. Sounds like a lot in 10 minutes. 4 I'll make quite briefly because I think they're pretty well known. I don't know that I need to elaborate in great detail on them. And then 3 I'll spend a little more time on. And the first 4 really concern financial system in the context of weaponized interdependence. And the first point I would make is that finance, to a large extent, is the most likely case for weaponized interdependence for reasons that I imagine we're all pretty much aware of. I think it's probably the clearest instance of what Jonathan Kirshner asked for last night as a consequentially sticky network structure. And it is a consequentially sticky network structure that is fundamentally based on the dollar in much of the ways that Rachel was speaking about. And therefore puts the US at the center and allows the US to kind of leverage its central position in ways that allow it to enforce its perception of laws internationally and impose costs. And I think it's sticky. One indication, I think Barry Cozen asked for an indication of how would we know if something is sticky. I think if you look at the international financial system, one needs only to look at 2008 when the US financial system was collapsing. And the response to that from market participants was to buy more dollars. And so in that context, the dollar strengthened, which suggests that even in the greatest financial crisis in recorded history, the dollar was everyone's first choice. So I think it's sticky and obviously consequential. Can American policymakers leverage this? It seems to me that the lessons of the last 20 years are yes. And we have done so, the US has done so pretty successfully in both a law enforcement context and in an attempt to impose costs on adversaries. So the global war on terror, case of North Korea and Iran in pursuit of non-proliferation objectives. These are the cases that I imagine we're all quite familiar with and can argue about whether the objectives have been attained. But in terms of imposing costs, yeah, we've done so quite effectively. And so secondly, yes, it seems to be success. Third, I think that, however, weaponizing finance is kind of a limited utility instrument. I think it has very limited utility because it's very blunt. It's not particularly susceptible to fine tuning. And so if we want to think about this in the context of actual war, it has more characteristics of a nuclear weapon than of a surgical strike. So that I think makes it somewhat limited applicability. And then also kind of like a nuclear strike, you really can't unscramble the egg. So once you use it, it's hard to put the pieces back together in ways that allow the system to recover. And I think the North Korean case is an excellent example of this, where we shut down the one of North Korea's major contacts of the international financial system, froze $25 million that the North Korean regime believed belonged to them. And then when they came back to the bargaining table, we lifted the sanctions. It turned out we couldn't find any way to get that money back to them because no bank would touch it to facilitate that transfer. And so picking up the pieces is different. And then fourth point is alternatives. Yeah, I know people have been predicting the end of the dollar, the end of the dollar-based system, basically since I started studying this and before. Hasn't happened yet. And at present, there isn't any viable alternative to it. I mean, people talk about SWIFT. And it's not a state thing, right? So Russia and Iran are creating an alternative to SWIFT. Yeah, who cares? I mean, fundamentally, it's a private actor thing, right? And to what extent are banks and other actors engaged in international payments going to use this other system? And so there really isn't an alternative. It's not something that states can readily create a substitute for. So it's like, if you build it, they may not come. So those are the 4 points I'd make about finance. And we can talk about those. The other 3 points I want to make really speak to kind of broader issues that occur to me as someone who's thought a lot about networks, thought a lot about international finance and the intersection between them. And over the last couple of years or so, trying to think about that relationship, networks, finance, in a perspective of complexity science. So let me offer you 3 insights, if you will, that might help us move the discussion forward. The first insight is, what's the value added, I think, is the broad question. I think Martha asked this in a very pointed way last night, and let me articulate this. I mean, we've been talking about interdependence back to, gosh, I like this, Albert Hirschman et al. In the late World War II period and beyond. And so then we have Cohen and I, and so interdependence is kind of a common notion. And so what is new here? What is new, potentially anyway, is to think not just about interdependence as being more, but to steal a line from Phil Anderson, more is also different. So what we see is a transformation of the structure of the system as a consequence of deepening interdependence. And I can give you a real concrete example of this. I would say if you look in 1975, the international financial system may have been increasingly interdependent, increased connectivity between what were largely national financial systems. For the subsequent 35 years, the world has changed. We don't live in a world of high connectivity between fundamentally equal or similarly shaped national financial systems. We live in a global financial system that's centered on New York. That's a different kind of structure of interdependence than we had 40 years ago. And I think that has implications that go beyond what Cohen and I were talking about in terms of vulnerability and sensitivity, in the sense that it's hard to reconstruct. About unscrambling the egg. Can we go back to 1950 and reconstruct a world in which all states are essentially homogeneous in terms of the financial systems, in terms of the economic structure? I'm not sure we can. So what does it mean then as we move forward? So that's one point I would say more broadly, is to kind of sharpen your notion of what you mean by this being a different world. I think in listening to the discussion over the last couple sessions, what I've noticed is that all this discussion is kind of actor-centered, and it has the following form. Given a network, and actors and states behave. It's not clear to me that's the only question we could ask. It's certainly an important question, but we could also ask, given how people behave on the network, how does the network evolve? And those are two very different questions that you approach in two very different ways. Where you try to take the network as a static thing and disaggregate it and try to think about what are the conditions under which try to leverage choke points that they have, or try to insulate themselves from those choke points. The other is, let's think about this as a complex adaptive system. Think how the system evolves as a function of reactivity to efforts to weaponize choke points. And so here the unit isn't so much individuals, states, private actors, it's the structure as a whole. And it seems to me this is, from my perspective anyway, one of the most interesting things is it's an alternative way to think about international structure. The interesting thing about structure is you think about the structure, not so much about agents within it. But I think that has two consequences. And this is the third broad point I would make. One is it's a structure, it's not a static structure, it's an evolving structure. So the first question is, how do we get here? And from my perspective, this is really profoundly puzzling or challenging for your framework, because if agents are rational and figure out that, oh, these choke points or vulnerabilities will be used against us, how do we ever let ourselves get into this world in which we can allow interdependence to be weaponized against us? And so this is kind of going back to, God forbid, realist notions of unwilling to allow ourselves to become vulnerable to manipulation by others, and yet operating in a world. And so how did we get here? How do we get from a very simple system, largely autonomous, into this increasingly integrated and quite different system? And then secondly, along the same lines, where are we going? I think all the conversation here is kind of within the structure. We talked about what are the conditions in which you can manipulate or use or insulate, but at the level of the system as a whole, where is the system headed? And it seems like thinking about how then the system will re-order itself as we move forward is fundamentally important. And it seems like there are at least three possibilities, obviously. One, we can have delinking, so it's kind of equivalent to the de-risking, which you see certainly amongst the private agencies. And so banks take less risks, and so maybe we have less kinds of transactions that are leverageable. It seems that where we are headed is toward a bifurcation. So maybe the system bifurcates, and so we're in an era in which the era of great power competition leads to weaponizing these interdependencies in a way that splits the system back into kind of a two-world model, such as we had between 45. And so maybe we get a bifurcation and two systems run parallel. And then the third is kind of the replacement or flattening. And so maybe more competition, maybe more flattening of the system. And so we go from hierarchy down toward, I don't really like the word multipolar, multiple reserve currencies. I don't see a lot of evidence of that happening, but still, it's certainly a possibility. And so for me, then I think that's kind of more broadly placing this in, as you said yesterday, in a more dynamic context, thinking about the structure of the system as the unit rather than individuals on it, and then trying to figure out how that structure evolves over time.
Move to Mark.
Okay, thank you. Again, thank you to the organizers for being here. Like everyone else here, I really enjoyed the piece when it came out. So the idea of having a conference on this, I think, is a really good idea, unlike most ideas for conferences, which are not really good ideas. That's just a personal opinion. Right. Okay, so the take home on this 10 minutes is the following. Finance is not the droid you are looking for in terms of this project. Basically, so, you know, Tom just said exactly what I thought he was going to say, and therefore I don't need to say it because it's the same thing, which is even with the SWIFT example, it's not SWIFT, it's the dollar. It's dollar clearing, right? So finance is the dollar. That's it. It's a movable object that isn't going to go anywhere because of the network externalities, and that's it. So in setting that up, I set myself the task of trying to think through some finance examples to prove that that's wrong. So the first one I thought was, well, let's think about if you wanted to weaponize bits of the financial system, what could I do? If I was an evil genius, what would I do? So I thought about centralized counterparty clearing institutions for derivatives trades where you basically book them. So people say both sides of the trade to reduce systemic risk, and you can do netting and things like that. And I thought, well, what happens if you basically deny them liquidity? What if you blow them up, if you do that electronically? Create a lot of havoc, but I'm not sure for whom or for what purpose. So that one didn't work. I was thinking about the repo markets. There's been this spike in repo markets, and that's certainly a network effect story. When you go from basically 6 or 5 large banks to 4 banks in the United States, and then you mandate that they have much bigger capital cushions, they end up controlling the collateral that is the basis of the repo markets, and therefore you just allow them to engage in extortion, which is what's just happened and why there's a spike. So there's a network story there, but it's not being weaponized. There's no state involvement. I was thinking about Brexit and the pound. The real interesting financial consequence of Brexit is what happens if the pound loses quasi-reserve currency status and it goes to parity. Then the Brits can't finance their trade deficit anymore, and they basically become kind of Argentina with finance. And that could happen, and there's lots of hedge funds out there betting both on the long side and the short side. But again, that's private actors. So, you know, they may be weaponizing in a sense, but it's not state. This is not your problem. That's why I'm saying these are not the droids you're looking for. The last panel was very interesting to me. I spent half a year to 9 months going to tech conferences precisely because I wanted to learn what these people were talking about. No. And they actually, this strikes me as more of the real space. And I'll give you a couple of examples. 2 years ago, Abbott pacemakers, you know about the pacemaker story? Anybody know about the pacemaker security threat? Yeah. So Abbott pacemakers, in brief, basically 500,000 implants in the United States. They have this wonderful thing whereby if you have a pacemaker, you can get an app on your phone so you can look at the voltage in the battery like you need to. But people love their phones, right? And what that also enables you to do is a firmware update. And that firmware update can stop the pacemaker. So 500,000 people could drop dead because of cyber hack. Apparently, at a tech conference, someone was talking about this. The real figure is 12 million. Kill 12 million Americans with a piece of code. That strikes me as an enormous vulnerability. The question is, why would you want to do that? Right? You can, but why would you want to do this? So again, in the tech example, there's a lot of talk in the tech circles about the splinter net, that it's already here. And this is basically how they talk about it. And I think this is much more productive for what you're trying to do. So why do American companies go to China? Because they're trading off market access for last year's tech. Why is there now trade conflict? Because China became, unlike most other developing countries, way too good at stealing last year's tech, to the point that they've stolen this year's tech. And once that happens, differential growth between American companies and Chinese companies disappears, and basically why you invest in US stocks becomes questionable and the whole thing becomes unstable. So given this, what do? Well, you've got a problem because politicians simply don't understand what's going on. A simple example of this is the focus on bilateral trade deficits, which anybody will tell you is economically illiterate, but nonetheless, that's what we focus on. Do you think these people actually understand tech? There's not a chance in hell of that ever happening. It's also far too complex to proof the system to make it safe. So to take the example of the Brits, Five Eyes and 5G in Huawei, there's estimated to be 850 million lines of code in the system the Brits will import. And there's 20 updates a month. Good luck supporting that one. And it's already happened with payments. Alipay, PayPal, Paytm, and the fact that there are no European digital platforms of size or scope or functionality suggests that that's already there. So in a sense, if that's the case, you know, finance is a monolithic block, which is a global network, right? This is not. This seems to me a space in which the types of dynamics that you guys are talking about are very much in play. The last thing I'll say is, but where I think it really is important, and it's going to become more important, and apropos pretty much all conferences we go to, you know how either there's nobody talking about the environment or there's the one environmental person you asked to be on the last panel because you don't know where to put them? Right, that has to change. Because this stuff's getting ridiculously serious. So as an example of this, I know. Yeah, I know. Sorry, but it's true. I'm trying to elevate you to the second panel, right? So I came back from a conference at the OECD. So remember the OECD were the people who gave you the jobs report, right? Labour market deregulation is fun, and capital controls are bad, and globalization is awesome. Well, they just had a 2-day conference called Averting Systemic Collapse. When they're shitting their pants, you know there's something going on. And here's the fundamental problem. I think this is why the environment as a network and as a system of networks that will be weaponized is an incredibly important area. So it goes like this. Pretty much all social scientists ever do is think in terms of 2 frameworks, equilibrium or mean reversion. Either it's getting to a stable state and then how do you stay there, right? Or alternatively, oh, things yin and yang. There's a business cycle, there's an up and a down, and you know, this too will pass, right? The problem with climate change is that it's a wicked negative convexity. It goes along and along and along and just gets worse and worse and worse. And we are hopeless at even beginning to think about that as a way of thinking about a social problem. So just to give some examples of where this might play out, biowebs, food, soil erosion, overfishing, deforestation, all have massive network effects that go well beyond any notion of state or authority in any sort of localized way. That's simply not there. At the OECD conference, there was an allusion to a French government report that suggests that French agriculture could be systemically destabilized beginning in about 15 years as the glaciers in France destabilize. And the politics of this get very interesting because it doesn't affect the Italians or the Germans nearly as much. So how do you run CAP when French agriculture is on the way to collapse? To a hat tip to Jonathan, this means that the Bordeaux futures that you and I buy are going to get infinitely expensive. So I'd start buying them as soon as you possibly can. See, there's always a financial upside, even in death. Carbon sinks, right? So Ireland, for example, has got this wonderful plan by 2040 to plant 44 million trees, which is very laudable. But in comparison to what's going to come out of the methane traps in Siberia and Canada and Alaska, why would you even bother doing it? In terms of distributional politics, if you want to do a Green New Deal, which I suppose most of us in this room think is a really good idea, I think is an absolute necessity, you have to face the facts that what you have is the brown states, by which I mean all the carbon heavy states in the United States, that are going to have to be bought off massively if you even want to attempt this stuff, which bespeaks a type of redistributional politics so deep that the United States would no longer be the United States if you want to get there. And for Europe, the notion of climate change refugees is something that within the next 10 years they're going to have to deal with. So if you think Salvini in Italy is pretty nasty politics just now, just wait until large parts of northern India literally become uninhabitable. Then you've got those wicked convexities in a whole new type of politics. So here's my question in closing and why I think this is the important place for you to focus your research. Actors try and weaponize these interdependencies to protect themselves. But what they're doing is they're protecting themselves zero-sum against the convexity. And the answer is you can't. So then what do you do? I don't know the answer to that, but that's the weaponized interdependence that I think is really important. You should start.
Elizabeth.
Thank you. Can you hear me okay?
Yes, very well.
Thank you. Thanks very much to the organizers of this conference, and also I'm very grateful for your flexibility in allowing me to participate remotely in this way. I'm delighted to have the chance to do so. I appreciate many of the points made by my fellow panelists, and so I'm not going to review them. What I thought I might do is just offer 3 quick thoughts before we move into a broader conversation. And I've had the opportunity to offer feedback and thoughts on Henry and Abe's paper to them in person, in podcasts, in writing, and various other formats. So I'm trying to.
There's a little lag.
I just said sorry, Liz. We put you under the bus.
No, my pleasure to do it. But what I thought I would do is actually try and offer thoughts that I haven't yet offered to you. So surprise, these are some ones that I think I haven't previously shared. So to be original. So the first one is that, though I think I have broached this a little bit before with you, but I wanted to make a comment on one of the questions that you've used in framing this panel for today, this panel right now, about the strength of the network effect. And I think I would say that in many places in the world, and certainly in the United States, the theory that you've put forward about the network effect being extremely powerful and I would say overpowering the desire by, say, sanctioned entities or those entities subject to other forms of US coercive economic power, the network is more powerful than those efforts at trying to get around it or circumvent it. And those small scale challengers, and actually you've discussed already, the panel's discussed the effort by Russia creating an alternative payment system or using a different currency. Of course, we've got others. We have the Instex effort you mentioned. We have a Chinese alternative payments example, and there's certainly others. So from Venezuela, of course. I think basically this is a strong theory to explain why the network is more powerful than some of those efforts to avoid certain change. They're not really going to have success at undermining these major nodes, and to just affirm what the panel has already said. The dollar is very powerful. US capital markets are very powerful as a overwhelmingly important, preeminent node in this broader financial web. However, that will change. What this network is not more powerful than are two things I wanted to point out, and two things that would really change the way we need to think about this theory. And the first is that if there is a broad lack of confidence in US economic management, for example, a debt crisis, or powerful malfeasance and mismanagement, and we see a real lack of confidence in US stewardship of the dollar and of US capital markets, that will be a kind of behavioral economic motivator for disempowering this US node, the New York as this major node in this network. And I think that's something that the theory here would account for, and I expect those of you on the panel would agree, although it's hard to see the specific catalysts that would create, maybe not entirely hard to imagine, but it seems unrealistic in the near future and possibly into the medium term to conceive of that kind of shifting the way that we saw in the post-war period from the movement from the sterling to the dollar. So it seems remote at this point, but that's something that would be stronger than the network effect, which is to say a incredible lack of confidence in U.S. economic stewardship would be stronger than this network effect. What I want to introduce here is that, and I've come to this when discussing theory, actually your articulation of weaponized interdependence with people who study China and the Chinese economy primarily. And I'm not sure that this theory, I think there's room for evolution in order to understand I just lost you. Can you still hear me?
Yes.
Sorry.
Yes.
There's room for evolution to understand what China is doing. So China, very strong state-controlled economy, looks to me like it is interested, based on political will, for bucking this network effect, trying to, if you will, short circuit the network or move around the network, accepting major inefficiency and economic loss in order to project power and to try and a policy change. And sometimes that's not to create tremendous economic effects, but more as a kind of political rebuke or humiliation for those that would challenge it over core national interests related to sovereignty or territoriality, for example. So one thing I think is elegant about the weaponized interdependence theory is that it can allow for a de-emphasis of certain state actors, except and instead talk about the power of certain market principles. But I think China is going to give this theory a run for its money. And I liked Thomas's point about given how people act in a network, let's think about how evolving networks, how the network will evolve. If I, you can speak to that too, but I like the idea of thinking about how China, as a powerful state actor that I see being interested in trying to override some of the nodes in this network, what that may necessitate about how the network will evolve. And I think that's a good way to consider how the United States will come to its use of coercive economic pressure in the future, based on this competition. And point I wanted to make is about cryptocurrency. And so there's a question about how much can non-state alternatives such as cryptocurrencies blunt the effects of weaponized interdependence? And the description for this panel, I'd like to challenge the premise of that question. Cryptocurrency is not a non-state alternative. And what may not be well known to some of the crypto enthusiasts is that, in fact, for example, if you live in the United States and you want to do business, you want to use Bitcoin or any other currency, cryptocurrency, you are subject to U.S. jurisdiction related to money or money transmission. And notwithstanding some of the pseudonymous or anonymous features of cryptocurrency. And the more that there are mainstream use cases for cryptocurrency, and there will be more, then the more that the world of enthusiasts and everybody else, the space for development of tokenized assets and cryptocurrencies will realize that it is actually a regulated space, and there is more that regulators will need to do to clarify things like, are certain assets, or are they commodities, or are they and some are both assets and money transmitters, and that has implications for how they're regulated. But there's already been a sifting of, for example, crypto exchanges, where some of them have embraced the notion that they want to live in the regulated space for various reasons, to take advantage of certain customer bases and use cases, and others that, like change location 6 times and reside in Malta, for example. But I do think that we are likely to see a scaling of a variety of tokenized assets and cryptocurrencies. But in order to do that, they'll need to have real opportunities to achieve any real scale. You have to have real opportunities to into fiat currencies. And that is a point of regulation. And that is what will be a kind of lid on certain innovations or scaling But to conceive of, returning back to the weaponized interdependence theory structure here, to conceive of any node, any meaningful node in a network that is a currency alternative, a non-fiat currency, a cryptocurrency, or some other tokenized asset, then it will have to achieve real scale and be a meaningful node, actually live in the regulated sphere, which means it will certainly be organized by state regulations. And even if they're pretty loose, like Malta's, Malta, but they have Cyprus and Malta, but it does mean that users will make their own decisions about how safe or stable they perceive that currency to be, whether they will want to, the same kind of calculations they make now about fiat currencies or financial institutions in those places. So there's a reason why, again, sorry, but Cyprus and Malta are not New York, and that's point number two. And
Approaching time, if you could just wrap up with the last couple points.
The last thing I wanted to say about, so where do we see this going from here? And we've heard, my fellow panelists have said a couple of other things about, do we see system bifurcation? Do we see something more, a disaggregation that might be, if you will, Mark, sort of more analogous to a splinter net, et cetera. But I just want to toss in here and say that I don't see a public policy or commercial case for any kind of utter bifurcation or decoupling between two big, say, clubs of trade, for example, around, or clubs of financial activity or data. So around the United States versus China, which I think is the one people most often sort of grasp for in their, as they're thinking about what disaggregation or decoupling means. I like the idea of splintering or the de-emphasis of the US node, and a rise in emphasis in others, possibly including in the tokenized asset sphere. But I would just say, I think there will continue to be, notwithstanding the politics involved, a use case for connectivity and certain kinds of financial or economic activity, and a strong use case for putting up brick walls in other areas, particularly related to some applications where we will see that kind of disaggregation, but I'm expecting significant unevenness. I'll stop there.
Thank you, Elizabeth. I want to start by inviting the panel to specifically kind of talk about the cryptocurrency part, because we didn't really touch on it until the very end. Now, Bitcoin, for example, we all know it's one of its primary functions is in illicit activity in financing, ransom, or people use it to pay off some illegal activities. And Paul Krugman, compared it to the $100 bill, saying that's its primary function, is to be an international use for illicit activity, and that is a place where weaponized interdependence can happen. Thomas, in your memo, you talk about the use of the U.S. financial leverage on the war on terror. Now, if terrorists can switch over to cryptocurrency, does that truly kind of take away the effect of the U.S. financial, even if the dollar stays as the center of global economy, that one aspect, could that take away from the U.S.'s leverage in the system? And I invite everybody, but if you want to.
I would differentiate between a law enforcement role, in which a lot of people engaged in illicit and illegal activities are encouraged to shift out of the regular financial system to the shadow system. In that sense, it definitely complicates the law enforcement task of preventing the flow of money, including terrorist activity. It's not clear to me that you can have, certainly at present, and although this is not my area, so I'm more than willing to be corrected on this, it's not clear to me how a state actor can react or respond to kind of weaponizing and kind of eliminating the ability to have your banks maintain correspondence accounts in the US by routing all their transactions through. So for the imposition of costs on state actors, it seems to me that the cryptocurrency constitutes less of a to the law enforcement.
I would agree, and I think Liz highlighted this obviously in the remarks, but this question mark of at some point, some of these actors need to touch the formal financial system. I think we're far, despite my, looking far in the future and raising questions about the, sort of certain payment systems, down the road, I think we're very far from that. Now the question mark is how much information gets shared from, sort of at each point, how laundered perhaps in the blockchain. I mean, there is sort of, and the like, but I think examples so far of state actors that have tried to avoid these, I think Venezuela is probably the biggest, case. Though one could also highlight that Venezuela is a country that is very opposing, sort of very opposing regulations, and Iran as well has, on the one hand, an interest in creating alternate payment systems, but also real concerns about entities that might undermine the government ability to control its money supply. So I think a number of those factors make it hard to see state actors utilizing it. It does bring up a broader point that maybe some of us alluded to when think about the system evolving, the way in which these networks reshape not only at the global network level, but the national linkages are quite important. So if we think about some of the literature that has highlighted that dominant financial actors, whether it's dominant actors with companies that maybe already have credit access, big banks that already have that flow of funds often tend to become more powerful because they're the only ones that either they're too big to fail, or they're the only ones that get access to some of that liquidity. I think it's hard to see some of these new sort of transmission being more than just a area for some small transactions. But we watch and see.
So crypto, I think there's a lot of information in state responses to the prospect of Libra, which is you're not getting to do it. This is pretty much the end of the story. The best monopoly that states have found in 1,000 years is the right to issue currency and ban alternatives. They're not going to give that up because Facebook thinks it's a good idea. Quite brutally. The other one is, I've always been quite amazed. Part of the reason I started going to tech conferences is because I wanted to figure out why people have been telling me there was a blockchain revolution coming for the past 12 years and I'm still waiting for it. And you start to look into the tech specs of this, you find out that Visa's faster than blockchain. And this is just bullshit on stilts. And the amazing thing about cryptos is it fails the basic test of the definition of money. So money has to be a unit of exchange, a unit of account, and a store of value. And it's neither. And particularly on the store of value one, it's crazy because it's so volatile. So if you wanted to use it for nefarious transactions, I mean, you might as well, I don't know, you could just put money in lottery tickets and probably get a better, more stable stream over time. So it's not a unit of exchange for anything. It's not a unit of account for anything meaningful, and it's hyper volatile. So by the time that you do your illicit transaction, you might have lost half of the value. And at the end of the day, it's like the gold. They're kind of digital gold bugs. I always find crypto people are kind of digital gold bugs. That you have the gold problem that once you've turned all your assets into gold and then put it on a boat and then run off to New Zealand, when you get there, you'll have to turn it into New Zealand dollars because nobody accepts gold. Have that transformation problem at the end of it. So in sum, I think cryptos is a kind of weird diversion and we should all stop talking about it.
And also, it seems that we think about groups responding to these dependence by ratcheting up the technological sophistication. It's not obvious that that's really the most common response. I mean, often it's just to really basic stuff, right? And so in the war against terror, the response was, well, we'll just resort to couriers and transport hard currency across borders. And that is not a cryptocurrency, right? So. And
in Iran.
Can I make a couple of points? just want to jump in here. So I'm not an evangelist for cryptocurrencies, and I'd agree about its severe limitations as a money system, not least because no one's figured out a successful like central bank function for an ecosystem of currencies. But nevertheless, I don't want to dismiss it because there's still, even if we think of it just as a highly volatile asset class, there's plenty of people who want to be involved in highly volatile asset classes because they see money to make off it. And so I let's not dismiss it there. And also, many mainstream actors have created their own tokenized assets. There's a JP Morgan coin and others. And to be clear, Bitcoin and other cryptocurrencies live outside of the formal financial system. They live in the formal financial system, which is one of the reasons why there are law enforcement efforts that go after users and exchanges to make the point about what you are allowed to do or not in the formal financial system. But I like the last point that Thomas was just making, which is to say, like, let's just have a gut check here for a moment and remember that, like, cash is still the most powerful. You don't have to innovate any more technologically than that. Like, it's still a profoundly useful unit to engage in all kinds of, financial criminal activity, terrorism, proliferation, human trafficking. The list goes on and on and on. And all you need to do is put it in a suitcase or put it in a pallet. And this is what's responsible. I mean, yes, it's true that Al-Qaeda and others still, they do use the Taliban, et cetera. There are use cases for Bitcoin. They have used it, and Twitter may or may not, knock them off the system for making solicitations for, Bitcoin, et cetera. But cash is still by far, by any account, the most useful way to do bad stuff with.
All right, thank you. All right, let's collect some questions. Sir, Mr. Rosen.
I was interested to hear the little exchange at the end about cash. I have the hypothesis that, in a weird way, the way you buffer against your dependence on the dollar financial system is by having $100 bills. And one of my hobbies is to go looking for estimates of the number of $100 bills in circulation outside the United States. It's hard to get good estimates. But there was one study, St. Louis Federal Reserve, that everybody cited for years, said the number was about 80 billion. I ran into a new, more recent study, also a Federal Reserve study, that had a much higher number that I basically found hard to believe. It was $500 billion. Right? The point was that we've been printing $100 bills like mad since the financial crisis, and they're going out the door. Right? So my question is just really a simple one. And by the way, big denomination euro notes are also in great demand. So my question here is, I can imagine the suitcase full of hundreds for a drug deal or a terrorist operation, but these quantities, if they're true, are much, much, much bigger than that. My question is, what do you imagine countries are doing with them? And is the growth of this stock, if it's real, basically part of the answer to the weaponized interdependence question? And this is the way they're evading. You can't buy treasury gilts anymore. It's all held as lines of software in the New York Federal Reserve. So if you want to actually hold something, you have to hold the hundreds. So do you have any insight into what's happening out there?
Well, just one guess is we have structurally negative rates. So essentially, cash becomes a hedge against negative rates, if you're holding financial assets. So a couple of years ago, there was a discussion of the Swiss banks as to whether they would start hiring warehouses to literally put cash in because of the problem of negative rates. So it simply could be people who have excess exposure, shall we say, to negative rates going forward start to basically convert that into cash. And then you don't want to put that much cash in a bank because it gets a little bit tricky. And then you end up with these basically off-balance sheet holdings, massive amounts of cash. That could be one mechanism, but that's purely a hypothesis.
I would add to that, it's also a good hedge against inflation. A lot of it is accumulating dollars to hedge against inflation of the devaluation of the local currency.
Yeah.
And point yesterday, I think you raised about billions and billions of dollars. Look, led me last night to go out and try to do some calculations about what the actual weight and volume of required to pay for a super tanker full of oil. And the figure I came up with was about just under a ton. And so that's a feasible amount of money to move, put it in a container,
Yes.
and ship it. So yeah, so
Except no financial
yes, absolutely.
showed up with a literally ton of dollar bills at a bank, they would, take a one look at you and say, you need to prove to me.
Yes, please.
No,
Yeah, but not at the Iranian central bank.
no.
But you don't have to. That's the point. They're hundreds. You never have to show up at a bank with $100.
The United States, not
What
Afghanistan.
depends who you're
Anywhere
buying it from.
else, you never have to show up with the bank with $100. You spend the $100.
So
No,
I
not
think.
necessarily. I mean, it depends on where you're going, but basically like major retailers or other institutions, or say you try and like classic money laundering techniques, you make 1,000 piles of 100 and you create different bank accounts and you try and deposit. Well, I mean, this is why there are supposed to be sophisticated anti-money laundering programs in global financial institutions. And there are some jurisdictions that get black marks from the Financial Action Task Force, for example, and we know who they are. But any other reasonable regional or global bank is going to be careful not to accept, for various reasons, one, violation of their own law, their reputational liability, and because they don't want to be criminally liable for facilitating illicit money transactions, being part of, what could be some major money laundering operation. They may not
But just
take the
pushing,
deposit.
right, but pushing against that slightly, I mean, there was a report from Copenhagen and the Copenhagen group and Zuckman 2 weeks ago that up to 40% of FDI figures globally are nothing but tax dodges. And no one's calling them on that. Jason Sharman's estimates of the effects of anti-money laundering legislation on actual flows are of the order of 1% capture. So, I think we risk vastly overestimating how effective these regulations are on the movement of cash around the world.
No, they're terrible. They're terrible. And the United States is a major problem country jurisdiction for everything that it's good at and for as much power as it has in the global financial system. Money laundering is a Class A problem in the United States.
But I think this is the question. Because I think the question is, how do those actors who have been excluded from the dollar-based system respond and survive? And I think the answer to that is they survive by using cash. And the cash is dollars. And so they're not, the Iranian central bank is going to take a ton of $100 bills. And there's not going to be any kind of problem because they're already under as much sanction as they possibly could
But for
face.
the purposes of this conversation, there's a second question, which is why is the U.S. government willingly cooperating in weakening this tremendous piece of leverage it has in the financial system? Why are we exporting vast quantities of $100 bills?
Because then they're dependent on us.
I'm sorry?
Because then they're dependent on us. The global currency, and you issue the global currency, then ultimately you're short dollar liquidity for everything. I mean, this is what we saw in the financial crisis. The European banks were borrowing dollars to buy US assets to convert them into euros. So when the crisis hit, they had to go to the Fed. Their own central bank was useless. So that's also true with the cash economy. And once you basically decide that the Venezuelan bolivar is the Venezuelan bolivar, and you're only going to walk around with dollars, you're utterly dependent on the monetary policy of the United States. It's an astonishing form of power. I would do more of it. I wouldn't do less of it. I would do more of it.
And
That's where
there's
you
a
see
link
the
to
leverage
fiscal
comes
policy.
from that we provided the $100 bill.
But what's the downside? What's the downside you see?
If your leverage comes from controlling the digital system, if that's where your political leverage comes from, creating a vast stock of capacity for evasion. But that's my only point. I mean, I understand the economic point that it's good business. You send hundreds abroad and they take them, right? And that's great. But I was asking the question in light of the current conversation, which is the leverage you're losing worth the leverage that you think you're getting?
Yeah, I think it is.
You think it is. Okay, you think it is.
Context here helps, right? So 2010, outside the US, $18 trillion worth of dollar-denominated assets held in the financial system. Compare that to $500 billion of cash floating around. And so it's the magnitude is, right, so much smaller.
Yes.
That it's not, it's trivial. That's what I would say.
Mr. Krishna, is your
Yeah.
comment similar, or do you want to hold off?
No, I'm just getting
I should
let-
stop by beating this one.
No? All right. Did you want to ask something different?
I would be delighted to answer. So it's not so much a question, but a comment that I'd invite the panel to respond to if they're curious to. Get back to this question of interdependence in the financial system. Respecting enormously, and I certainly should, the robust role of the dollar and its network effects and its sustained role that is not going away. To invoke Gilpin's law, right, that every international monetary system rests on political foundations. Go back to the Middle East in this long comment and make the observation that even if markets rule, the U.S. saw the need to supplement the role of markets with political understandings, both in 1973 with the secret deal arranged by Secretary Simon, and in 1978 with the secret deal made by Secretary who said, well, maybe markets will keep this all in dollars, but we want to go and cut secret deals about this. And maybe that was unnecessary. But I'm very curious because the glue that held those political understandings together, an American security guarantee in exchange for promises to hold lots of dollars and keep oil priced in dollars, both sides of that seem to have less compelling logic to me than they had in the past. I would not want to hitch my wagon to the star of an American security guarantee in the Middle East just about now. And similarly, the change in world energy markets is such that Gulf oil is way less important to the US than it was in the past. So in light of all of that, and with respect to the dollar's robustness, I'm very curious about the Middle East as an arena in which we see movement in the ways in which money works.
Jump on that, or did you want
No,
to?
no, I can't.
Okay.
I'm happy to take a crack at that one. I think you're right. So I think there are two concerns about, sort of the sort of set of things we've been talking about where the Middle East is concerned. One is what does a U.S. security guarantee mean? But the other is in a number of jurisdictions in the broader Middle East, of course, some of these involve both individuals, but even some state actors that have been that have been held, face the challenges of weaponizing the dollar. My sense is that there's a lot of thought about it, but I don't really see the Gulf countries leading this charge. I think there's a lot of concern every time if you're starting to see whether it's diversification or other moves from the Chinese or even the like, but I don't see, we have some players in the Gulf that got ahead of the curve and maybe they didn't diversify their funding sources, but they diversified their savings platforms. I'm thinking about sort of what Abu Dhabi has, and to some extent Qatar did with their sovereign funds versus the sort of dollar legacy and the Saudi foreign assets, right? And so so some of the smaller countries got a little bit ahead of it on the saving side, which I think is critical. But I see them lagging rather than leading. But this is something where, but that would be somewhere to watch. And that's where I think in highlighting this, to what extent are we going to start to see challenge and volume in the global energy sector that's in non-dollars. There's a lot of talk, particularly from European think tanks and the like, of could we start to see other benchmarks? We have some other benchmarks in other currencies, notably in China. There's not been a lot of volume against that oil benchmark. I think natural gas might be somewhere to watch. partly because natural gas, unlike oil, is more based on, and I'm willing to be contradicted about that by all the energy experts that are in the room, but natural gas, long-term contracts, and there's been this question of should natural gas be priced off of oil? Should it be pegged to coal? Should it be, what's that pricing structure? Is it still regional? Is it becoming global? So that might be some question. So I see that happening first before oil, but Middle East is a region to watch.
We'll go to Abe and see if Henry also has any comments, but then we'll go to Professor Jersey.
This was maybe a comment to just the whole panel, which builds off of what Marty brought up in the last panel, which is the learning effects. Henry and I, we have a kind of a complementary piece in the national interest where we think more about this dynamic process in finance. And I think we came to this similar conclusion that the dollar is probably pretty solid as a network effect, but that there are these experiments that are being run in order to route around other parts of US financial power. So whether it's evading the panopticon effect, creating kind of these small islands where China can do stuff and not be seen by the US system. And so just kind of what you think about these learning effects. The one I was very interested in recently was the Hong Kong's attempt to buy the London Stock Exchange. So, for me, that's a node play. It's like, can we make a node? Yeah. So I'm just wondering where you would see these potential experiments. I get the dollar's powerful story, but I want to see the others, the kind of the unexpected experiments that are being caused by weaponization and how they might play out if you were going to fantasize going forward.
I think the biggest one's Belt and Road. The Belt and Road Initiative is entirely about getting out of dollars. So basically, China's exports to GDP peaks in 2008. Ever since, but because the economy has grown so fast, then basically the denominator expands. So there's still massive exporter. The result of this is that they can't stop earning dollars because they keep importing dollars they can't use in their banking system. And the easiest thing to do is to turn that into an interest-bearing asset, which is a 10-year treasury. Any given moment in time, they constantly, I think basically monthly, they're pulling in somewhere in the region of 200 billion, and they've got to recirculate that. So Belt and Road was basically, well, we can hold paper assets that allow the Americans to behave like lunatics and we pay the bill, or we can basically convert that into real assets, and that's basically going around and building ports and roads and everything else, and then getting the rents from that because those are real returns from real assets. So I look at Belt and Road primarily, well, not primarily, one good way of doing it is dollar diversification, and I think that's the most obvious place where that's happened.
There's another one that I'm watching. Is it okay?
Yeah, go ahead.
Okay, which is, it also sort of ties to BRI, but as far as experimentation, I think this is something that China is actively involved in, but trying to encourage and promote payments mechanisms, digital payments mechanisms that are essentially like along the Belt and Road corridor, where you're creating Chinese tech for constituencies of people who may be underbanked or unbanked, so they're not already connected in the network, which isn't to say they don't have access to units of value, but they haven't been as hardwired as so many of the rest of us into the network we are very influenced by. But so Chinese payments technology, which also could involve denomination of payments in the renminbi, which may help in the project of its internationalization, and which can have other effects for China, affording many other opportunities for growth, maturation, development of some of its products in its capital markets, and of that, its sort of money system more broadly. Be clear, by capturing people who are underbanked or unbanked, you're not necessarily capturing people who have a whole lot of money to deal with. So it's not as though you are capturing an enormous amount of units of value to play with, but there's rather a lot of people, and it's not crazy to think about Chinese payments technology in Africa between a retailer and a customer where they're using Alipay wallets, exchanging renminbi, and that becomes, you're covering a lot of ground and achieving a successful experiment for China here as creating different nodes and even separate networks.
Henry, I just want to give you a chance to have any
Sure.
comments.
So I've got a question which is aimed primarily at Liz and Rachel. And this is a question about whether there's a vulnerability in the US use of weaponized interdependence in the financial world that we're not focusing on, which is the importance of regulatory deference. So if one were to imagine a world, say, in which the Exxon case results in an unexpected outcome, and where it's suddenly much easier for foreign financial entities to challenge decisions that are taken by OFAC in court, what kind of consequences does this have for the US ability to project power using weaponized interdependence in financial sector, and for the ability of OFAC to really push sanctions and to use sanctions as a strong tool of foreign policy?
It's sort of a follow-up on this, because in some ways the thing I'm struck by in terms of this conversation, particularly with respect to the dollar, is that if you would ask me 10 years ago the likelihood of another currency supplanting the dollar or rivaling the dollar, I would have been more confident 10 years ago than I am now, which is a hell of a thing to say if you think about it, given A, the 2008 financial crisis, but also B, the degree to which the US has weaponized the dollar over the last decade. And the reason that you're all nodding in agreement with me, which I'm very grateful for, is that, is that as much as the US might have abused or might be, exploiting its centrality of the dollar, the other possible alternatives, namely China and the European Union, have shot themselves in the foot repeatedly on this.
Right.
And so in some ways, the reason this ties into Henry is that I keep wondering, why is it that other actors haven't developed the domestic institutions, both on the regulatory side and to some extent, if they were actually be successful, on the sort of OFAC, CFIUS, weaponizing side? Is it that they're simply slow learners? Is it that it hasn't occurred to them? I'm genuinely puzzled why you haven't seen at least even initial moves towards creating a domestic architecture that could potentially, in the future, deal with something like a reserve currency.
Just to add to that, I think that you're beginning to see a push towards this in Europe. So the money laundering stuff that's happening at the center, I think, is an initial push by some people in the Commission towards this, and we're going to see a lot of bargaining over the next couple of years, because the big problem in Europe is it's a national, it's a member state versus a European, the standard fight in the EU. And it's plausible, at least, that some of the member states are beginning to decide, screw it, we would love to keep these competences, but we're going to keep on getting shafted by the United States if we do it. We need to move towards something which is more centralized. And so, it could also be that there's enough opposition among other member states to stop any centralization, but there's very clearly a movement going on. And if you read the stuff which is be coming out as Commission, as the commissioners talk about what they want to do, so that is the background music that you hear in a lot of their statements.
Comment or?
Yeah, I have a number of comments on this. So on regulatory deference, I often call that regulatory arbitrage, but I think we're talking about the same thing. And absolutely a consideration. And to the extent that companies can engage in that, let me come back to that, they're going to. And we see this all the time. And there's great examples. In the EU, because while policy is set centrally, as I think someone just pointed out, that it's up to the member states to implement. So there's an opportunity to move, if you can, to move to a different EU member state where you think that they'll be less likely to enforce certain measures, including around data or sanctions or what have you. And arbitrage, think about one thing I'm trying to watch carefully these days is how foreign companies in China are reacting to changing perceptions of risk or actual legal targeting in this US-China trade competition or economic competition. and which companies are choosing to move supply chain or manufacturing activities outside of China, or R&D activities, even move it outside of the United States in order to avoid having to fulfill regulatory obligations to the United States, or be targeted either by China in retribution to the United States or by the US of entities in China. So is that all a version of regulatory deference or arbitrage? I think so. I mean, and there are other examples that are more specifically related to sanctions, not just trade. However, companies that are enormous and have a global footprint, they are in the you're a bit penned in here, and there's no version for just to take sort of, you know, Microsoft, Apple, IBM, just to pick on them for a second. I mean, there's no future where it doesn't involve growth in China. Or, you know, like major other US manufacturing. There's no version where you figure out deference or arbitrage and you decide to just stick it to the United States. So this is one reason why you see certain companies that are basically the test cases. They are the laboratory, and we're seeing some kinds of separate and distinct supply chains or R&D activities. So there's like made in China for the China market, and then there's manufacturing or R&D that might have been in China because of inexpensive labor or other conditions, but that's moving outside of China, and that's for a different market, if that's meant to be for export reasons. So I mean, there's like micro versions of this happening, but when it comes down to financial sanctions, which are, I mean, because of all of the reasons we have said about the power of the dollar, you want to have any exposure to US jurisdiction, and that means use of the dollar, US citizens, US technology, I mean, all of that, then you have to live by US rules. If you are a foreign company and you don't market to a US audience, but you somehow still get touched by that system, like maybe you rely on, you know, your HR systems or supply chain management systems are US tech, and you have a couple of US citizens, something like that. So you're still stuck, and you have to be, and we see that all over the case. You know, why was it that US unilateral reimposition of sanctions related to Iran have had such powerful success? It's because all kinds of people who want to stay away from the United States otherwise are complying. They see that they nevertheless have exposure. As far as the question on other institution countries creating an OFAC, I don't think that's right. And the best case, and in fact we do see it happening, it's not happening everywhere all over the place for a couple of reasons, but it's like a true OFAC parallel. In the UK, the Treasury has created this their version of OFAC. I mean, I think they'd even call it their version of OFAC. It does some different things, but one of the big motivators for them was facing Brexit. They've had to push very hard, very fast to get ready the legal structure that would allow them to hold in place the same sanctions on the day of Brexit, so that there isn't an immediate unfreezing of, you know, trillions that have been frozen to sanctions in UK jurisdiction. So they're on it. Germany has been developing further apparatus in this domain, although I think, as a couple of you were getting at it before, that's not that's in some ways to like counter and push back on and try and deal with frustration and anger about US sanctions, not just to mirror what they might appreciate about sanctions. Anyway, and then I do think that we could look at some of Europe's work on its money laundering directive, and of course its data privacy rules, as versions of taking their own actions around leveraging their own strengths. And is that weaponizing? Maybe it is. This is a very powerful set of defenses for Europe about not sharing certain data or not allowing it to be captured by other jurisdictions. So that's I think maybe if we expand I think that was Dan asking the question, but expand the umbrella a little bit, maybe we could think about that as different flavors, but a kind of institutional development in other jurisdictions that has some of the same objectives.
Could I just specify the question a little bit more precisely? So when I was talking about deference, really what I was thinking about was something like the following argument. So you've got the US, US regulatory decisions have enormous consequences around the world. And the US has been very successfully able to weaponize this in pursuit of a variety of strategic objectives. It is extremely difficult for foreign actors to challenge these decisions in US courts because of the basic regulatory deference, especially in this space where national security and economics hit each other. We have, of course, now a case taken by Exxon, which is seeking to challenge this over a relatively minor set of sanctions. So the query then is, what, and in some ways this also goes to what Rachel was saying, this is the obverse of the JCPOA problem, is that that one of the reasons why businesses are shit scared to do business with Iran is because they worry that OFAC is not necessarily going to be constrained in its future decisions by what it has said in the past, especially when a new when a new administration comes in. And so then the question is, if we see a world in which US courts ruled in favor of Exxon and have sort of substantially or sharply circumscribed the apparent deference to OFAC decisions, allowing other foreign institutions possibly to challenge these decisions in US courts, would this significantly undermine the ability of the United States to weaponize sanctions in a sense, or would this just be a pain in the ass kind of thing that the US would figure out ways to deal with?
So we only have 1 minute left, so I want to, with that, and give final word to Thomas because you haven't talked in a while. So we'll give you the last.
Wake up. So I'll give my final word to Mark. I also
All right.
hasn't spoken much in the last minute.
Good, I think we've exhausted the last 60 seconds.
All right, so
It's unanimous.
So in the last minute, I'm going to use the last minute. Sorry. So there have been predictions, and this is just a quick lightning round. That in 1995, Jeffrey Frankel predicted that no currency will take over the dollar by 2020. And unless something happens in the next few months, he is right. Let's add another 25 years. 2024, is the U.S. still the global currency? Yes or no?
2024?
Sorry, 2045.
Yes.
Okay.
Sorry, wrong. 25 years. I'm adding 25 years.
Yeah. Oh, go ahead. I'm not sure that that's the right question.
Okay.
Some of it depends what is the global currency.
Well, I mean, some of it depends on how the rest of the world changes. And I think the rest of the world over the next 25 years is going to change. And not in the ways that we're talking about, but in many of the ways that Mark Blyth has been talking
Depends.
about. Yes.
Perfect. All right. Thank you so much, everybody. Sorry, did anyone?
Oh, I was just going to say, and this gets us to the answer to Dan's question. Liz dealt with the OFAC question, but there's also a question mark of control and comfort with from some of these jurisdictions of losing the control that implies being a reserve currency. And I think that's one of the, that's one of the reasons why it's hard to see meaningful, broad-based alternatives, even if pockets of.
I just want to, it's an interesting point because it suggests that the US economy over 70 years is adjusted to the fact that the dollar is the reserve currency, whereas every other country is adjusted to the fact that they're not the reserve currency. And trying to change that is not, you want to talk about networked, weaponized interdependence, that's nothing compared to the sort of institutional rigidities we're talking about. So that's something else to consider.
Yeah.
All right, cool. Please join me in thanking our panelists and